And your previous panelists will be playing themselves, but I'll be playing Ronald Trump. Ronald Trump, sorry. Ronald Trump. Slipped it. And I'll do my best, because I'm not a professional actor. Okay, next slide. Okay, so let me set the stage for you. Ronald Trump, me, has come to the conclusion that he doesn't have the time to manage his wealth. He has come to the offices of MASECO Global, a one-stop wealth management firm based in Hong Kong. Ronald will interview the partners of the firm to see if MASECO Global would be the right fit. And here is Ronald's situation. I'm 55 years old. I'm the executive at a multinational company headquartered in Hong Kong. It's called Trump International. I'm married to Melanie. I'm a U.S. citizen, but my residency is in Hong Kong. My wife Melanie is a Hong Kong citizen and a tax resident. I have two sons. Ron Jr., age 25. He's single and he works and lives in the U.S. in Los Angeles. And he lives in an apartment which I gave him money for. And my other son, Jaron, he's age 19. He goes to college in New York City, in the US. My annual compensation is $500,000 base US, plus up to 1x. So I can get up to $1 million a year based on how performance is. I own a real estate. I own an apartment or a flat here in Hong Kong worth 30 million Hong Kong dollars. And I own 3 residential rental properties in the US, in California, total worth 3 million, and my wife manages those properties from Hong Kong. I have $1 million Hong Kong dollars in a bank account here with HSBC, and I have $100,000 in a bank account at JP Morgan in the US. JP Morgan manages most of my wealth, $20 million. Back in the US, and they charge me 1% AUM. And I have self-custody crypto, Bitcoin and Ethereum. It's worth $2 million as of today. I have a Roth IRA at JP Morgan, $1 million. And I have a family limited partnership. So I've done some estate planning. We're not going to really talk about estate planning with MASECO Global, but we started it, and we have 8 million in a brokerage account, and they're charging me a 1% fee. As far as my U.S. tax filing, I filed jointly with my wife, and I file a non-resident tax return in California. I intend to retire in 5 years and split my time between US and Hong Kong. I really love Florida, so that's where I intend to retire to. All right, my wife Melanie has been urging me to talk to someone about managing our assets. I'd like to invite Eric and Mark and Charo. By the way, the video will be edited for television, so we'll cut out all the mistakes and things will be cut out. Okay. Okay, audio. So knowing my situation, Mark and Charu, how can your services help me and my family?
All right. So, Ron, good to see you here. And I think Melanie's given you a very good suggestion of coming to meet us, the wealth management arm of MASECO, to see how we can add value. We understand you do already work with an advisor, a bank, a large advisor.
Okay. The reason I'm coming to talk to you is because they do nothing. Yes. Maybe they send me a holiday card, but that's it. I get no calls. I feel no love. So I want to come talk to you.
Absolutely. And I guess that's why, the wealth management arm of MASECO would add tremendous value to your situation. So as you're evaluating and assessing how we add value, I'd like to take you through not just what we do, but also how we think when it comes to overall holistic wealth management, and how that would align with your long-term goals and your complex financial situation. So, like you mentioned, you are a U.S. citizen in Hong Kong. Your wife is your non-U.S. spouse, and your adult children are in the U.S. So, you ideally need somebody who can bring all of these moving parts into a cohesive strategy and at the same time give you specialist advice across investment management, US and international tax, estate planning, asset succession planning, and protection planning. Now, how we add value, how the wealth management arm of MASECO would add value to your situation is, firstly, like you mentioned, your current advisor sends you holiday cards. Now, firms like ours, we specialize in serving US connected people with a focus on jurisdictional wealth management, and we try and give customized bespoke services to all of our clients. We customize holistic financial solutions for them in a very boutique fashion. Unlike a large bank where you are just one of their many customers, we try and give more bespoke boutique solutions to you. Our approach is built on the principle that exceptional wealth management transcends borders, and we essentially thrive on cross-border complexities. Now, where we would add value to your situation is tax-efficient investment strategies, expertise in US products, so whether it's IRAs or it's trusts or it's 529s in your situation. You have grown-up children now, but you may be looking for planning for your grandchildren eventually. Global custody solutions with multi-currency flexibility. And what would interest you a lot, Ronald, here is our scientific and academically driven investment philosophy that's backed by behavioral finance and rigorous research. So what you find within our investment portfolios is global diversification, low cost, and I emphasize on low cost, and I'll be talking about that later on as well, and tax efficiency, rule-based factor investing that helps you achieve higher probability, increase the probability of enhanced returns. Apart from that, Ronald, where we would add value would be in terms of multidisciplinary expertise. So integration of your investment strategy, tax planning, estate planning, protection planning. So coordination of your insurance, long-term healthcare strategies, long-term care strategies across different jurisdictions. Cost benefit, and this is an important one. You currently pay approximately 1% fee on your AUM, which is quite punchy. So at our wealth management arm, we focus on lowering the costs across the board for our clients, and this would essentially mean lowering of the fee that you would pay. So even a 30 to 40 basis point reduction in the overall fee that you would pay would make a massive difference. So we understand, Ronald, you have been very busy working for everyone around the world, and you've been busy with world peace. But what we can offer you is peace of mind by taking care of your financial solutions in a holistic way and at a very low cost.
So what is your view if I wanted to give specific input? Like I want to invest in this or I want to do that. How do you guys treat individual?
Okay, so we are a discretionary asset management firm. So what that means is the clients will typically delegate the authority to us to make trades on their behalf. However, we, on a case-to-case basis, between our offices in Asia and London, we do have the option where the client can give us execution-only trades. So that option does exist, but we are discretionary, which means we would do trades on your behalf. And the idea of that also is to do rebalancing on your behalf on a periodic basis, so that there is you don't drift away from your ascertained risk goals.
And as far as rebalancing, how often do you typically rebalance?
We would typically do that twice every year, so once in March, once in September.
Okay. All right. Well, thank you. That's a pretty good explanation. Now I want to talk about the markets. So talk to me about the stock market. It's crazy. You know, what did it tanked? The S&P dropped yesterday. 2 days ago, it went up today. Yesterday, now looks like it's going to go down today. So what's going on? Let's talk about it.
There was obviously a question surrounding tariffs, especially in the U.S. Tariffs, I think it's important to understand what it is first, and it is a tax. It's a tax on the country putting the tariffs on. So everyone in the U.S. is paying more for everything because of those tariffs. And when the current administration is saying, oh, we're raising all this revenue, what they're doing is basically taking money from all the consumers of the U.S. and keeping it for themselves in the government. And so it doesn't really help anything. And what tariffs tend to do is drive an economy towards stagflation, which is like the worst of all worlds. And so one of the ways to get around that is by diversifying globally. And so at MASECO, or at MASECO, we invest in 50 different countries.
Okay.
And we also have roughly 16,000 underlying positions in our portfolios. So we can do away with the unsystematic risk by diversifying that way. And when it comes to systematic risk or market risk, it's still helpful to be in multi-jurisdictional areas for investment.
Okay. Now, how about, I'm just talking to my friends at parties, and all they want to talk about is Mag 7. Why wouldn't we just put most of our money in the Mag 7 and let it ride?
Okay, well, that's again, you know what? It wouldn't have been a bad idea for the past 10 years. However, everything that goes up comes down eventually. And the reality is right now, the Mag 7 accounts for nearly 35% of the total value of the S&P 500. And if you take NVIDIA off, if you take just NVIDIA off, out of the S&P 500, you had the same return as the Topix in Japan over the past 10 years. So diversification is important, but it's also really important to understand that if you take the Mag 7 out, the other 493 stocks of the S&P 500 have done very middling. And if you look around the world currently, the developed market ex-US has done better than the US, and emerging markets has done better than the US in this year. So we look at global diversification because, getting back to what Charlie was speaking of, our academic approach to this, which is backed by multiple Nobel laureates, shows that over time, a global portfolio is better resistant to shocks in the market than being what we call a home country bias, which most people have.
So before we move on, what is sort of your take on the Hong Kong stock market, China? Like since we're here,
yes.
Like what is your take on it?
So you, as an American citizen, the only thing you can do from a Hong Kong standpoint in terms of investing that won't make it tax inefficient is to invest in individual stocks. Now, we generally don't advise that for clients because it's risky. I've lived through the time of Global Crossing, Enron, you name it, they're out there. And so we try to stay away from that. We use low-cost ETFs. And for US connected clients like yourself, we will custody in the US because it's less expensive, and we take care of all the tax reporting for you, and then you don't have to worry about having to include anything on your FBARs or if you have to file a 3520 or something like that for trust, you can get away without doing that.
Okay. So I have another question about have you here. So if the US dollar fluctuates,
yes.
Who knows if they will ever repay their debt? I mean, What do you make of that?
Okay, so yes, the US dollar fluctuates, but it hasn't fluctuated until Liberation Day. Prior to that, it had done nothing but go up since 2011. And the reality is the dollar is down. And it's also one of the reasons why being diversified globally is important, because the other countries are benefiting from that decline. And it's possible that if these tariffs stay, which already have on average across about 300,000 different items in the US, have increased prices on average about 7% since the start of the tariffs. So it's not an insignificant number. And so you need to make sure that you cover yourself as best as you can by being diversified.
Okay.
And as far as China directly, we do not trade in China directly. We use whatever is listed on the Hong Kong, on the HKEX. We can trade through that.
Okay. Well, I'm glad you guys talked to me, because my people in New York from that other bank don't talk to me about this stuff. So thank you for that.
Sure.
Okay, so I want to move on to what are some financial planning ideas for me?
So being in Hong Kong, first and foremost, you understand that you still have to file your US tax return. Just make sure we understand that.
Yeah.
But more importantly, doing things like you've already done, setting up Roth IRA is always a good thing. Once the law changed in 2017 that allowed for backdoor contributions to Roth IRAs, very big deal. And we've been doing that with lots and lots of clients, because think about it, when you get into the retirement phase, you're going to want to be able to make your distributions from taxable and non-taxable accounts as efficient as possible. And you can keep yourself under a certain band by using more, for instance, of the Roth IRA. You've already started with the flip, which is a good thing. I don't know if that's set up under a dynasty trust or not. I'll let the other people in the firm talk about that. But some of the other things you should be doing and thinking about is planning. You've got, your son is still in uni, probably too late to set up a 529 for him, honestly. Maybe not, but you also want to start thinking about planning. How are you going to distribute your assets in your lifetime? You need to think of short, medium, and long-term goals. Short-term goals are things that are right now. But planning and gifting is part of the conversation with every single client of ours, because they all have the same types of issues. They want to pass it on. They don't want the government getting as much as they want. You've already gone over the lifetime allowance in the US, which is currently 13.99 million this year, going up to 15 million next year. And your wife doesn't have that, because she's a non-US citizen, which I assume our legal people will talk about QDOTs, but we will, that's one of those planning techniques that you can use to pass on some assets. Then there's, do you call her Melanie or Mel?
It's Melanie.
Melanie.
Yes.
Do you plan on making sure Melanie's okay? I mean, you're the earner, and clearly there is,
well, if she, of course. Well, if she behaves, of course. But yes, of course, I plan to take care of it. Yeah.
So you'll want to think about ways to transfer some assets. You can transfer 190,000 in 2025 to her every single year. That's something you should be doing anyways. She should have her own money to work with. And the idea is that you're going back to Florida. How long are you going to stay there? Are you going to be there forever? I know you want to split time. It's not clear what kind of time. But obviously, if she's going to become a permanent tax resident in the US, you're going to need to do some planning around that.
Okay. That's a lot to think about. And the last thing I want to ask about are, what are some ideas for optimizing financial goals for someone with my background?
Optimizing financial goals, that is all about cash flow modeling and planning. And we do that with every single client. And while the investment piece is great and it's very important, and that's what's going to grow the wealth over time, the planning is more important. And we spend a good deal. In fact, in every single review meeting, I would say at least 50% of the time is spent planning, looking at what the goals are, short, medium, long term, making sure that we've allocated resources appropriately for each of those buckets. and making sure that over time we're checking in twice a year minimally to ensure that we're
Well,
hitting
I'm high
those
maintenance. I expect better than twice a year.
4 times a year, 6 times a year, whatever you want, we can do it.
Okay, well, thank you very much.
Typically,
Yes.
like, we typically would meet twice every year. I mentioned it could be 4
I like
times
to be
or
taken
more
to the
often.
club. I like to go taken on a boat, those types of things are great. But thank you very much. Now, I'd like to talk to your tax partners.
Thank you.
Ronald, nice to meet you.
Hey, nice to meet you.
Yeah, fortunately, RP can be
Yeah.
here, so, but he's online, so.
Can we see him? Or are we just gonna hear him?
It would be better if we.
Okay.
Okay.
All right. Let's just get started. The Mark and Charlie talked a lot about tax compliance. So why don't you talk to me in detail? What are my U.S. tax compliance obligations?
Okay. Uh, Good evening, Ronald. So to start, just to take note, the U.S. is a citizenship-based taxation, meaning for as long as you have that green card or U.S. citizenship, you need to file and declare your worldwide income in the U.S. So automatically, since you're a U.S. citizen, you need to file your Form 1040. Another thing that we need to consider is the U.S. is a federal-based tax system, meaning we need to evaluate whether you need to file in a specific state. In your case, Ronald, we've noticed that you have income and asset source in California, which means that but you have not stayed in California for at least 183 days. So that means that you still need to file in California, but only the income or losses that you've generated in the state, which means that you need to file your Form 540 NR. Now, going to like the common pitfalls, first thing is the crypto assets. So I've noticed you have crypto assets. So one thing that you need to look into when it comes to crypto assets are the taxable event, right? So just make sure that you cover all those taxable events when it comes to crypto. Take note, liquidating a coin is a taxable event. Converting a coin to a different coin is a taxable event that could generate capital gains taxes. And then lastly, like incomes from forking, staking, those are considered by nature ordinary income, which will be taxed at your current ordinary rate. Another thing is to take note is there's no treaty between the US and Hong Kong. So if you have retirement accounts and all, such as MPF, just make sure to add in your worldwide income the interest, dividends, employer match that comes in with those retirement accounts. And then lastly, if your retirement accounts are investing in, like, let's say, startup companies and suddenly you have control, take note of the GILTI requirements. So you need to add portion of the income, even though dividends are not yet distributed, as your income taxable in the US currently. And then lastly, I just want to take note about like the forms that you need to add in your 1040 because you're you're an expat. First is if you have accounts or bank accounts that hits more than $10,000 at any time during the year, you need to file Form FinCEN 114 or formerly called FBAR. Another thing, if your assets by the end of the year financial assets by the end of the year is around 400,000, you need to add Form 8938 into your individual tax returns. So just take note of those compliance forms, because if you miss those willfully or not, it could entail some penalties and interest on your end.
All right. Okay, that was a lot of stuff. Okay, that's why I'm coming to you. I don't want to have to do all this stuff and learn all the technical rules. But what I can tell you is the current firm I'm using is charging me $8,000 to do my returns. Is that too much?
Yeah, honestly, for compliance work, if they're only doing compliance work, it is too much. Here at our firm, we do not only the compliance work, but the strategizing for you. So at least every quarter we meet with you, check in the status. What are your added investment? How much are your added income this year? We strategize on top of making sure that you're compliant for every other US aspects that you need to comply on.
Oh, wow.
Yeah.
That's great.
Yeah, and on top of that, we also welcome anytime if you have any questions, you can give us a call, send us an email. So as what Arvi mentioned, we do have tax planning quarterly. So we can have a sit-down session with you and talk about your plans, your current situation, and have to strategize how to reduce some of your taxes.
Well, that's a lot better than my current firm because every time I send them an email, I get a bill. All right. So I have another question. My kids keep asking me for money because, you know, they like to spend. They're just like their mom. Any issues with that?
Morally, there might be, but but tax-wise, for as long as you are aware of the threshold, there won't be any issue. The first threshold that you need to factor is the $19,000 threshold. So if the gifts per person or per kids already exceeds 19,000, then you need to file a gift tax return in the US. However, it doesn't necessarily, it triggers the it's a threshold to file, but not necessarily mean to pay gift tax. So cumulatively, if over your lifetime your gifts exceeds 13 million, that's the only time that you need to pay gift tax return. Another thing is foreign gifts. So in your kids' return, they may necessitate to file Form 3520. So this form needs to be added if like the foreign gifts exceeded 100,000 during the year.
Okay.
Yeah, and the good thing about our firm at MASECO is the admin part. Of course, we do take care of that a lot for you, but what you just need to remember are the thresholds. So whenever you send out money, think about what the effect could be on your possible tax compliance.
All right. That sounds good. I want to. Okay. Are we gonna be able to fix that? Okay. All right. So, okay, that was a cut. Okay, roll. So the next thing I want to talk about, next slide, please. So, you know, there is this big legislation. You know, I'm too busy here in Hong Kong to pay attention, but a couple of months ago, people were talking about this big, beautiful bill. So what is that? How does that impact me?
So the one big beautiful bill, this was the bill that was signed into law last July 2025. It clarifies, revokes, or supersedes the old tax law. So in your case, Ronald, oh, by the way, our firm will conduct trainings when it comes to the one big beautiful bill. But in this case, in your scenario, Ronald, so the things that you need to look into, first, you won't need to worry about the added taxes. With this one big beautiful bill, we are back with the normal rate, because initially before this one, the current tax bracket will expire, so it will increase our taxes by at least 2%, but you don't have to worry about that right now. Another major change would be the SALT deduction. So from 10,000, it's now up to 40,000 when it comes to like the taxes that you've paid in the state or property taxes. However, take note of your income when you're strategizing. We need to make sure that your taxable income is lower than 500,000 to avail of that 40,000 SALT cap deduction. And then lastly, the very important one, and I believe this is applicable to high net worth individuals such as you, Ronald, this is the kind of a revised version of the piece limitation, meaning in your case, the more that you exceed in 750,000 income, the lesser itemized deduction available to you. So this one, we first, on our firm, we need to at least strategize to help you go lower than 750,000 to avoid that threshold. But also, if we don't have a choice and it will your income will exceed the 750,000 threshold, we also have some strategies to at least lessen the impact of this new limitation.
Yeah, and just to add to what RV mentioned, since you do own rental properties and you have a partnership that you own as well, so we can also definitely look into strategies of incorporating the new 100% deduction of depreciation. So previously it was cut to around 40 to 60%, but now it's back to 100%. So definitely there are some opportunities and planning there.
Okay. All right. I think I've heard enough. I mean, that was just too very technical, but I trust you guys. I trust that, at quarterly meetings, I just tell you what I'm doing, and you take care of everything. Okay. So the next thing I wanted to talk about or ask about, well, I'm asking for a friend, and not saying I would ever do this, but talk to me about expatriation. What if I want to leave the US?
Got it. So if in case your wealth manager, such as like Charu, allowed you to give up your US citizenship to save some taxes currently, so you have to take note about the covered expatriate and not covered expatriate rule. In this case, unfortunately, you are a covered expatriate because your net worth is more than $2 million already. That means that we need to strategize to at least lessen the impact of that exit taxes for you when you give up your US citizenship. So there will be a lot of planning, but again, you need to pay an exit tax before you can give up your US citizenship.
Okay. Well, we can cover that later.
Yeah, definitely. Since we are a one-stop shop at MASECO, we would be doing the decision making with you, and of course our your wealth planning managers, Charu and Mark as well. We can all sit down together and talk about what the impact is on tax, on your wealth planning, and everything all considered. So yeah.
Okay. But if I expatriate, I won't be able to live in Florida. Will I?
You still can. So yeah, maybe as a on another form of visa. But take note, once you may trigger next in Florida, there's no state taxes. However, in case there are states wherein you've stayed for more than 183 days, you have to take note. You may need to file your tax return in the specific states that you've stayed for more than 183 days.
All right. Okay. So now you mentioned my real estate in California. There's some planning ideas around there. Can we talk about that? What are some ideas you have?
Sure. So it looks like your rental properties are frequently incurring some losses and they're worth $3 million. So this one will focus more on strategies that will help you increase your tax savings currently, not in the long term. So the best one here is converting your properties into active properties so that those losses can help you in reducing your 500,000 income. So what are the strategies that are available to us when it comes to converting the passive losses into active losses? The first one would be, I know it might be hard, but converting it into short-term rental properties such as Airbnb, right? The moment you convert it into an Airbnb and act as if it's a hotel, then you can convert the property is converted into an active property. Thus, the losses can be used as a deduction to your active income. Or if it's not possible, the second one, this one, I believe this is the best strategy for you, Ronald. Your wife is can qualify as a real estate professional. A real estate professional is an individual who spends more than 750 hours a year in real estate related activities. More than 50% of her time spent is in real estate, and at the same time, she is materially participating in the properties. So she qualifies as a real estate professional. And since she's a real estate professional, regardless if it's a long-term property or short-term property, the losses can now be used as a deduction to your income. Plus, apply what we call the cost segregation bonus depreciation strategy, which is what Rigel mentioned a while ago. In your case, based on experience, the $3 million worth of property in the year that you convert into a real estate professional, or you convert Melanie into a real estate professional, you will save around $210,000 in taxes minimum, just by using that cost segregation bonus depreciation study. That's not yet factoring in all other expenses of the property.
So you can save me $200,000. Why don't my current guys didn't say anything about this?
That's just the minimum because of the strategy. Plus, there are yearly strategy because your wife qualifies as a real estate professional. So there are more savings on top of this $210,000.
All right. Okay. So the next thing I wanted to ask about is, or at least tell you my feelings about, is that I'm paying way too much tax in Hong Kong and the US. Talk to me about ways so I can reduce paying taxes to two jurisdictions.
I know. As much as possible, we want to lessen the impact of double taxation, which means like for the same income, two countries are taxing you. Two countries are like taxing you on the same nature of income. In this case, in the US, there are two available credits or exclusion for you. The first one is the foreign earned income exclusion, meaning you can reduce up to $110,000 of your earned income in the US, so that at least it will lessen your the taxable wages here in the US. Another thing is the foreign tax credit. So this will come in handy because the Hong Kong pays like around 15% in taxes, but in the US currently you're on the 35% bracket. So at least in the US you can use whatever you pay in Hong Kong as a tax credit here in the US. Plus you can stack both strategies to further lessen the impact of double taxation on your end.
Okay. Okay, we'll have to talk more about that later. And then the last thing I wanted to cover was, well, you know, I'm an important person, and I'm kind of too important to retire. But let's just say I do. Is Florida really the best place or a good place to retire to, as from a tax perspective?
It's one of the good places, but yeah, my suggestion is if like you're planning to stay in Florida during retirement, then upon the advice of your wealth manager, go for it. Because first, there's no state taxes. Second, they do not charge any state tax when it comes to an estate or inheritance tax. So it will come in handy during your retirement. You only have to worry about the federal taxation during that time.
Yeah, plus there's more sun in Florida.
And good golf.
Yeah.
Yeah. Okay. Well, I think that's it for now. Well, thank you, RV and Rigo. And now I'd like to speak to the client, private client partners in your firm.
Thanks for your time.
All right. Thank you. Okay.
Hi, Ronald.
Hey guys. Yeah, you guys
Meet you.
look very professional. So some of my friends have set up something called a family office. What can you tell me about a family office? Why should we use that?
Very good question. So a lot of people talk about family office these days. A lot of people thinking, oh, that's tax incentive, so it must be just setting up for tax benefits. But actually, a lot of people actually don't know what is a family office. They just say, oh, my friends are setting up a family office, so maybe I should get one for tax benefit purposes. But yeah, just a family office is obviously more than just for tax planning purposes. There's estate planning. It's allowing you to manage your assets in a more professional way, especially for people like yourself with multi-jurisdictional assets, different classes of assets, and you might want to have more control and hands-on control on your investments, and possibly to think about more legal, tax, and other complicated issues. And it's generally only beneficial for people with more significant wealth. I think in your case that kind of fit that in, because obviously you need to think about there will be running costs for having family office.
Okay, so typically in your experience, like what is sort of the minimum threshold where you see in net worth before people start thinking about family offices, where it makes sense?
Yeah, I would say around at least 40-50 million US dollars, because yeah, as I said, it does require some running costs. Yeah, probably 1 to 2% of the annual AUM, and also for places like Hong Kong, for example, we have tax concession for family offices, but the minimum AUM is 214 million Hong Kong dollars, which is about 30 million US dollars. On that note, obviously I understand from your description earlier that you got some immovable properties both in the US and Hong Kong, and also cryptocurrencies. So to qualify for tax concession in Hong Kong, you do have to invest in qualifying transactions or investments. And in that case, under the current regime, immovable properties are not qualifying investments, and cryptocurrencies as well. So you kind of marginally fit that box. But that being said, there are concessions. The consultation paper that came out recently and hopefully will come into law soon, that it will include non-Hong Kong immovable properties and cryptocurrencies. So potentially that could fit yours as well.
Well, I'm actually hurt that you told me that, like, now I'm marginally gonna meet this qualification. I can't go to my friends at the party and tell them I can't set up a family
In the
office.
future, well, no, you do now,
Oh, okay.
and in the future, when the law, well, when all the consultation became law, and then you definitely will fit in, because immovable properties outside of Hong Kong and the cryptocurrency that you invest.
That's what I like to hear. I like that. Okay, because I need to brag to my friends. So now I know my friends also talked about like Singapore as well. I mean, what's the difference? I mean, is Singapore a better place?
Yeah, I guess, yeah, when you set up a family office, there are actually a lot of considerations to make, right? Well, firstly, should you have one? Because for some people, it doesn't actually make sense to have a family office if they have very simple family, like just the parents and a single child, right? And then they all live in Hong Kong residents. It probably doesn't need one, but for your case, it probably worth thinking about that. And then where to set up the family office? Yeah, Hong Kong is one consideration. Singapore, and it really depends on where you plan to reside, where you plan to have people, because you do need substance, and also where if you want to hire somebody, where can you find a talent, right? So that and also obviously professional help where it's best fit for you. So there's places like Singapore, Hong Kong, but also people also consider the UAE, like Dubai, Malaysia. Those also kind of common places for people who live in Asia that think about possible locations to set up a family office.
Okay. And while I have the financial partners here, I mean, do you handle family office investments? Have you done that before?
In a similar fashion,
Yes.
yes. It's not like we don't have the attorney to do all the legal side of it, but
Okay. So if I use your firm, like, we've got a one-stop shop. I don't have to go find another people. Okay, great. All right, so I have a lot of friends. Okay. And some of them have also talked to me about trusts. So what can you tell me about using trusts?
Oh, that's another great question from you. So yes, people can definitely use trust, and trust has been used by private clients like yourself, a very important person, as sort of wealth planning for themselves and also families. In fact, a trust can be used in conjunction with a family office. So the trust, in essence, is also a legal arrangement. So it can be placed between the actual founder and the actual family office entity, so normally being corporate. So a trust fits perfectly within that structure. So if you think about putting aside the family office structure, you can also use the trust as a standalone sort of structure. So some of the reasons for people to think about establishing a trust will be for wealth planning, wealth protection, so asset protections, a pooling of all the family assets together, which then allows the family to sort of distribute the family income to the family members more efficiently in comparison to, say, for example, having a company where the dividends can only be distributed to the shareholders. Yes, however, for using a trust planning or trust structure, a careful planning needs to be considered. So especially for yourself, who's connected to the US, because without the careful planning, there will be adverse US tax implications. So some of the things then you consider will be where the grantor is, for example, and the citizenship of the grantor, like yourself. So you're a US citizen. So there are some sort of trust structures that you can put in place, which you could protect your asset whilst getting some tax benefits. For example, your wife, Melanie, yeah, she's a non-US person. So again, you can set up a trust for a non-US person that you get benefiting the US beneficiaries. So in that sense, then it comes down to quite a few different structures that you can potentially think about it. So we'll talk about for US person first. So when people talk about foreign grantor trust, people commonly get mixed up between setting up a foreign grantor trust for a US person and a foreign grantor trust for a non-US person. So for a US person, basically, a trust will be regarded as a foreign grantor trust if provided that it does not satisfy the control test. In essence, basically meaning whether the trustee is a US person or a US entity. The next test will be the court test, so whether the US court will have jurisdiction over this trust. So if it's not, then the foreign grantor trust will, or the trust will be regarded as a foreign grantor trust. So when we talk about foreign or a grantor trust, basically, you as the grantor, you put assets into this trust. However, you're not really relinquishing most of the rights. So when we talk about revocable, basically it means you can terminate the trust anytime you want or change the trust deed. So in that sense, from the US income tax perspective, they consider that the asset still belongs to you. So in that case, what happened is you will get taxed on all the income that's generated by trust. However, if you say a foreign non-grantor trust, basically it's another word of saying it's an irrevocable trust, meaning that you are unable to terminate the trust or you are unable to change the trust deed unless all parties agree to it. In that case, then the income generated by the trust is no longer taxable in your hands. It could potentially taxed by the trust, or if the trust makes distribution to the beneficiaries, then the beneficiaries get taxed on those trust distributions. And if you yourself and two sons are all based in the US, those trust distributions will be taxed under the US income tax law. So we talked about the for US person, whereas for a non-US person, it's much more straightforward. So Melanie, she's not a US person yet, a US citizen. So therefore, what she can do is she can set up a trust while she maintains that non-resident or non-US person status for the benefit of the US person. However, the downside of that will be she will have to remain as a non-US person or non-US tax resident. So in that case, depending on your future planning movement, it may or may not be the most suitable options. So that being said, if you think about setting up a foreign grantor trust for Melanie, then again, it's broken down into two parts, revocable and irrevocable. So revocable, again, for US tax purposes, it's seen as her property. So therefore, from a US tax perspective, they don't really care about whether she paid tax already. So she can then distribute the income to the US beneficiaries. And that trust distribution will not be subject to the US tax.
Okay.
Yeah.
Okay. Yeah, I mean, we can work on the citizenship issue with Melanie because, I mean, she doesn't like me around anyway. So, I mean, she can stay in Hong Kong, you know, whatever, and I'll just hang out in Florida. And I think we can work that one out.
That's right. And also, just one other thing it is you can also think about setting up a dynasty trust.
Oh,
So dynasty trust, so basically it's another form of irrevocable trust. It's sort of been set up to plan for the estate tax and also the generation skipping transfer tax. So that allows you to efficiently pass down your wealth to your kids and your grandkids and future generations. So that's another potential options. However, the only thing is when, especially for a US person setting up an irrevocable trust, there might be tax implication when you transfer the assets into the trust. But that being said, again, the estate and the gift tax sort of threshold has been increased. So it's now about $13 million, and next year will be 15 million. So you could utilize that lifetime exemptions as well as the annual exemptions. So that allows you to do capital planning and transfer your assets into the dynasty trust.
okay. Well, I do like the sound of the Frump Dynasty Trust because none of my friends have one of those. So, let's work on that. Let's work on making a dynasty trust, the Frump Dynasty Trust. And the last thing I want to talk, I know our time's running short, but I want to give you as much time as possible because I find this topic really interesting. So when I attend these parties, people also talk about life insurance. Like, I don't need life insurance, I'm wealthy enough, but what do you know about these products? How could would they make sense for me?
Yeah, actually, it's quite popular in Hong Kong or in Asia. There are a couple of life insurance policies that actually is good from a tax planning perspective as well. Kind of similar to a trust in that sense. And actually, we've got clients where they have a family office where they use a trust, and then under the trust they have a life insurance policy. Typical policies are private placement and life insurance, what we call PPLI, or variable universal life insurance, VUL. And they basically put the assets under the policy. The benefit for that is that you basically, it's very specifically tailored to the policyholders, the investment needs. And the benefit is basically it achieve a tax deferral because the value increment is not taxable. And then at the same time, you can potentially get some of the cash out through a loan, as long as you keep the amounts below the cash value. So that actually has some tax benefits. But then obviously there are costs because you obviously have to pay some fees for keeping the insurance policies. It's not very high, and also you don't have as much control in terms of your kind of investment decisions.
Okay, so I want to talk about that the borrowing concept. So I can borrow against the cash value, and if I borrow, that's not taxable.
As long as you borrow up to because it's just like taking your capital out rather than taking the increasing value out. But obviously you have to watch out for the cash value in case it goes down. Then obviously you have to repay that at that point. It's not taxable. So obviously you have to pay interest as well.
Right. Okay, so basically I can use that. I can borrow money off of my life insurance and just go make more money.
Potentially.
Oh, I like that idea. I think that's our time, and I thank you guys so much. I mean, this was very informative, and I really like MASECO Global. It's a great firm, and that ends the formal part of our presentation. So thank you for sticking with us. So these are QR codes. So this will allow you to have the copy of a presentation electronically. So if you can scan the code. So I'll give you guys a second to scan it. You know, we didn't want to print all this out. Everybody got it? And these are, it'll be in your slide deck, but this is the contact information of all of our speakers. And if we need to get a hold of Yeah, if we need to get up, sorry, if we need to get a hold of RV and Rigo, we know how to do that. You just find me there. So I'm not getting to you, but, so that's it. Any questions? Thank you to our presenter, and in the back, there's, some snacks and some wine, and please feel free to join us in partaking in that, and the speakers will be around to answer questions. So thank you again for sticking with us.
Thank you.